You're now listening to the Tax Smart REI podcast, the number one tax podcast for real estate investors.
Hey, thanks for tuning into this week's episode of the Tax Smart REI podcast. Today, I'm joined with Nathan Sosa, a senior tax advisor here at Hall CPA, to dive into a new court case related to real estate professional status. This just continues to be a heavily audited topic, and with additional IRS funding, the audits will only increase from here. So if you're curious about what factors led to this taxpayer losing in court and what they could have done differently, you'll love this episode with me and Nathan. We'll be diving into all that in just 1 minute.
Most landlords are closer to achieving their financial goals than they realize. They are just a few moves away from meeting their cash flow goals and finally achieving financial freedom. Introducing Property Llama, the game-changing tool designed to help you unlock hidden opportunities in your real estate investments using the equity you've already built up in your portfolio. Property Llama is an online investment platform built by real estate investors for real estate investors, and their user-friendly dashboard gives you a crystal clear picture of your entire portfolio, and their team of real estate experts is there to help you plan the moves you need to make to hit your goals faster. With Property Llama, you can track and benchmark your investment's performance, model what-if scenarios to make smarter decisions, and work with their team of real estate investment professionals to discover new investment opportunities and accelerate your portfolio. When you sign up at propertyllama.com/taxsmart, you'll receive a free personalized one-on-one portfolio review with one of their real estate investment experts. Again, visit www.propertyllama.com/taxsmart to get started today. That's it for now. We'll dive right into today's episode.
So I would like to be the first to welcome back Ryan Carrier to the podcast because he has been gone on paternity leave for the past month with the birth of his little one. And I cannot say how happy we are that Ryan's back and with us, but we're also super glad he got a chance to spend time with his family, be with them. That's so important. And glad everyone's doing well, doing healthy, Ryan, sounds like at least. And so super glad, but also we're glad to have you back and with us again.
Thanks, Nathan. Yep, my family's doing well. Glad everything seemed to run smoothly without me. Thank you for filling in for me and Justin filling in as well while I've been out. And just so everyone else is aware, Tom is out this week. I think he's moving to Miami.
He is.
So for those of you who have been listening to our podcast for a long, long time, this has been years in the making. And if you go back years of listening to the podcast, this has been something that Brandon and Tom have been joking about for a long time. So I think it's happening. He's really gone. I think he's really leaving New York for who knows how long, but he's currently on vacation out of office doing that. But yeah, my family's doing great. Thank you for welcoming me back. My wife and my daughter are doing fantastic, about a month old now. But yeah, so let's just dive into actually why people should be here, kind of what we're going to talk about today. So essentially, before we jump in, I just want to back up a little bit. We're Hall CPA, real estate CPA, is what people really know us as. And we have now for the past several years, I forget how old our firm is now, 8 years or so, been helping specifically real estate investors save, at this point, hundreds of thousands, maybe millions of dollars in tax savings at this point. And again, we just specialize in real estate. So one thing that we're going to talk about today, the whole focus of our conversation today is this new case called, I think it's Ferratus versus Commissioner. This just came out this summer, 2024, if you're listening sometime in the future. And really what we want to help people see is this individual, this taxpayer, claimed real estate professional status. Super, super, super common, thing that we discuss all the time with our clients. Me and Nathan are both senior advisors helping clients, figure this out. Does this work for you? Why? Why not? And we're just going to deep dive into this one case and really help people listening. Why didn't this work? What could they have done different? Were there any clues at the beginning that said, you weren't going to meet this in the first place, right? But then we're going to switch it to, well, what else could they have done, right? Or who is this a good fit for? And things like that we're going to talk about. So that's kind of what we want to move into. And so Nathan, why don't we just kind of move into then, the big picture context of the case, kind of some of the details, the data points, walk us through this case that came up this summer.
Yeah, definitely, Ryan. So the site for anyone who's ever interested, we'll drop it in the show notes too, but it's TC Summary Opinion 2024-13. And it could be Ferratus, whatever. I'm not sure how to pronounce his name. If somebody knows him, let us know how we can pronounce it, and then we'll get it right the next time. But this case is super interesting because it's a real estate professional case. It is also a short-term rental case, which is really intriguing that it is both at the same time. And so from a high level, the taxpayer, Ferratus, ended up creating an ADU, a carriage house. He constructed it on his property to rent out as a short-term rental. Now, we don't have the exact details of was it an average 7 days or less. We don't have the exact details of what the stay was or anything of that nature. We just have a few key points. And basically, he was a full-time W-2. His wife was a full-time W-2. And they also constructed this building all by themselves. I say by themselves, obviously contractors, et cetera, right? Like there are things that he couldn't do. He hired someone out for, right? Normally not a big deal. So he did a lot of construction himself. However, he didn't go for or argue the short-term rental strategy like we talk about so often here and so often with our clients. He wound up actually going at this from the angle of a real estate professional. And that's what ultimately doomed him at the end of the day. And that's something that, like Ryan mentioned, we would talk about with our clients. We would advise against this. It's super interesting to have a short-term rental case just because, like, sure, like some people say there's no short-term rental cases. Well, there are some out there. They exist, but they're not as common as real estate professional cases. So it's really intriguing to get a real estate professional case that is also a short-term rental case simultaneously. So it's interesting to see here. Essentially, he didn't qualify because he's got a full-time W-2. And whenever you have a full-time W-2 per 467 CB, if you spend more than 50% of your time doing something else and the court doesn't believe you on the time you spent on something, they're going to disqualify you every single time. That's the unfortunate case. And so like, this is the high level details right now. We'll definitely take a deeper dive, but unfortunately coming at a short-term rental with real estate professional status while working a W-2 job is going to result in losing every single time. And basically like the reason we care about this is he had $22,000 in losses that he didn't get to use because of this. And so that got disallowed, got viewed as passive, not active. And so he wound up having to pay tax at the end of the day.
Do we know the numbers or the tax bracket that 22,000 was at?
Yeah, so actually, he and his wife both earned. So it's another interesting thing that actually literally just occurred to me is that like it says that his wife was earning $82,000 and he was earning $78,000. So actually, they were just over the $150,000 threshold technically, which is another layer within a layer here. Actually, now that I think about that, like we don't talk about that today, but it's like basically they're outside of the ability to use that, right? And short-term rentals can't use passive activity loss anyways. So it would have been intriguing to see that get argued or discussed, but they were over that bracket, so it didn't even matter. But yeah, so they were essentially in the
22%.
Okay, yeah, that's right.
Yeah. So we're talking like, if we're just going to take at face value $22,000 of losses that on their tax return, right, they claimed real estate professional status, which would trigger that $22,000 to be running through their tax return as non-passive. What the court is saying is, we don't believe you. And because we don't believe that you've met real estate professional status, that $22,000 should have been passive. But because they're above this other exception other than reps in the short-term rental strategy, because they're above that modified adjusted gross income of $150,000, you can't take any of those passive losses, right? So now the court is saying that's all passive. So in the terms of tax dollars, if you want to look at it as like maybe a refund that they would have gotten otherwise, or that they accidentally took that they shouldn't have, that would be about $5,000, $4,800 that they took. And so just to point out one thing here, we're not talking about millionaires here, okay? We are talking about fairly low income people that the IRS said, this is really easy. We're going to win this. And you probably have seen a lot of things on the news with our current political, we're in October 2024, but just other ways, like you've probably seen a lot of things where they're targeting people who make a pretty substantial amount of income. We keep hearing this like 400,000 plus in income. Here's an example for those of you out there who are lower income, below that 400,000. And here's an example of them getting audited, right? You might feel like, oh my goodness, why are they even auditing these people? Well, because of what we're going to talk about next, which is the main crux of it is these people are both taxpayers, full-time W-2 employees, assuming then that they are both working 40 plus hours a week, which comes to about 2,000, right? Roughly hours a year. The IRS is basically betting there's no way that either one of them worked more than 2,000 hours for this rental property, right? So that's what they're betting on. So again, not a lot of dollars in terms of taxes and not this massive amount of like income, taxpayers were going for, but really just like how easy this seemed to be for the IRS. And now we've got yet another real estate professional status case. Any comments on that before we move on?
Yeah, so like it's like honestly what you can do is like so they didn't even like perform a cost segregation study. So like they could have you could have added a whole zero to that loss, right? It could have been $220,000, right? We don't really know the entire amount at the end, like we don't know the entire amount that they sunk into it. So we don't know 100% how much it cost them to totally build this. We just know what the ultimate loss was at the end of the day. Maybe we could back into that if I really wanted to, but essentially you could have added maybe a zero at the end of that. And then you add a zero to that refund, right? So it goes from a $5,000 refund to a $50,000 refund. And if they'd argued an incorrect strategy, even then, they still would have lost, right? And so the whole reason this ended up happening is because they both, like Ryan said, they both worked, they testified in court, they both worked 2,000 hours a year at their job. Miss Moore, his spouse or partner, straight up said, I didn't work it all on the property. It was all Fortis. He did it all himself. And he said he spent 2,500 hours working it all by himself. And maybe he did, right? Like construction projects are hard. They're time consuming. And like some people say, like, look, we're grinders. We will do whatever it takes to get this done. We'll do everything by ourselves. Like there's multiple instances of people, like there's a lot of entrepreneurs out there who are willing to put in the hours and do all this. Unfortunately, the court doesn't really believe in people who say they work 40 hours a week and then another 48 hours a week on top of that. Right? Maybe he did. Maybe he was a grinder. Maybe he did all this stuff himself, but the court just didn't believe him. They said, no, like, I'm sorry, but we don't think that you are spending that much time, right? You're basically spending 12 hours every Saturday, every Sunday, and then spending several hours coming home after work and working on this property. What's really interesting to me is that he did have logs. He did have other types of things that to try and substantiate this. Now, the accuracy of them, we don't know because the court didn't even get there. There's like, we don't even believe you. So we're not even going to analyze your logs right now. So like, and the evidence was so like, and I did some like digger deeping into this. Like he had evidence submitted. He submitted it, like whether or not it was constructed right before an audit, during the audit, et cetera. Like we have no idea. We have no idea. Like maybe he actually was listening to the podcast back in 2020 and actually did have these logs, but missed this one step because he wasn't working with us. Right, Ryan? And it's like, that's one of the key aspects here. And like, let's not forget, yeah, this is a reps case, but this was potentially a short-term rental that had an average day stay of 7 days or less. And if that's the case, he came across with the argument, again, I don't know if it's counsel, if it was himself, or he had someone working with him, they came at this totally the wrong angle. Because under 469, short-term rentals, if they're an average day of 7 days or less, do not apply to 469 by this aspect, right? And so if that's the case, he would have been fine having a W-2 job, right? That wouldn't have been an issue. Also, let's say he is super aggressive and we knock out 1,500 hours, the 2,500 he said. That's still 1,000 hours he spent constructing this activity, got it placed in service. So since it's placed in service in 2020, this is the tax year that everything happened, gets it placed in service in 2020. So that means all those hours that he spent constructing the property now qualify. The other thing he did do is he also got a full-time property management company to take care of every aspect of running it, right? It's a red flag with the IRS generally. Now, let's say that he did qualify for the short-term rental. In this instance, average 7 days or less, et cetera, right? We know all this stuff. Then even then, he would have blown any management company out of the water, right? Like there's no way. I think it only had maybe $8,000 of gross income for the year, maybe a little more, a little less. So clearly didn't have a ton of stays. So a management company would not have spent 1,000 hours taking care of the property. Even for a full year, it'd be hard to find a management company spending that much time, right? Like maybe some are more hands-on, maybe some more hands-off, but he would have cleared away, knocked out of the park short-term rental strategy. However, I don't know who his advisor was, or if he had one, or if he argued for himself, but there just wasn't enough education that went into this. And because of that, he ended up losing. Sure, maybe it's $5,000. Some people, it's not a lot of money. I would take $5,000 tomorrow. But it's the fact that like he did not work with someone or he was not educated enough to approach this properly. And that's the big takeaway, I think, from this case is that if he had a stronger argument and argued this properly, he could easily have won. And then we would have maybe tossed in a cost seg additionally, something like that, right, to take advantage of larger losses. But at the end of the day, because of that, he didn't even basically, this is a 5-pager tax case. I've read some tax court cases that are like 80 pages, more or less. Basically, this is open and shut book for tax court judge. So they didn't even like, there's like, yeah, we've ruled on this a billion times before. Sorry, man. Well, I'll see you later.
Hey, are you tired of working with generalist CPAs that tell you can't use the real estate professional status, the short-term rental loophole, or cost segregation studies, or worse, have no idea what these things are? If so, it's time to elevate your game and work with a CPA firm that gets it. Here at Hall CPA, we worked with thousands of investors, helping them save millions of dollars in taxes through proactive tax strategy and planning, tax preparation, and outsourced accounting solutions. So if you're ready to elevate your game, make tax filing painless, and save thousands of dollars in taxes, what are you waiting for? Just head on over to www.therealestatecpa.com/podcast to request an initial consultation today. We are accepting clients for the 2024 tax year, so if you're looking to make a change, you have nothing to lose. Again, you can request an initial consultation by visiting www.therealestatecpa.com/podcast. We look forward to hearing from you and learning more about your situation and how we can help. But for now, we'll dive right back into today's episode.
I have a lot of comments on that. So one is, like you said, Nathan, we don't know exactly what the average stay per guest was, it sounds like, based on the 5 pages that we have from the summary. So that's something we're not sure of. Certainly, if they were like, let's say, working with us, we would have kind of helped them understand, like, okay, should this be proactively, right? Should this be an average stay less than 7 to claim the short-term rental strategy instead of this craziness of real estate professional status? But maybe they would have come to us and said, hey, no, it's going to be a long-term rental. I can't do a short-term rental for X, Y, and Z reason, or I don't want to because of these reasons. Okay, that means it's going to be a long-term rental, and therefore you can't claim reps for ADIS, right? Because this is going to be a huge red flag because you've got these 2 full-time no one's going to buy that, right? But then on top of that, right, point 2, like you said, Nathan, coming to us to say, hey, they also had a full-time management company. That would have been step 2 as far as the path or the plan to change would have been, hey, the first year, let's just not have them, okay? Let's just have you manage it for however many months that was, and it sounds like 2020, right? And that's a year of 100% bonus depreciation, which is another thing we could talk about for the cost segregation study. Again, they're in the 22% tax bracket. We're not talking, 37% bracket people. But at the end of the day, then we could have been talking about, hey, action step 2, you need to be managing this at least the first year to, 1, reduce any sort of red flag from the IRS, because what probably came up on his P&L was an expense for management fees, right? Probably another trigger when you submit your tax return to the IRS. They have software, believe it or not, okay? They have a lot of funds. And so we submit our tax return electronically. They've got all these things running through your return to say, does this make sense? Should we audit this person? Is this a high risk? When we ever use the words red flag, that's at least what I think, okay? You could think of red flags for before they had all this tech as someone like literally physically looking at that return. But they have so much software now that they're just going to skim through that stuff, and it's going to pull for the audit teams that they have. It's going to pull this stuff. And so again, the red flags where they've got 2 full-time W-2s and they've got this management, okay? But the goofy thing, like Nathan's saying, just to reiterate it, is they tried to go for real estate professional status. Again, we don't know the average stay, but maybe we would have advised them for the short-term rental strategy and maybe a cost seg, depending on the numbers and things like that. So again, the next thing there just to highlight is the management company. So if we can, for those of you listening, first year, try to not have a management company in order to get more material participation hours and not have to compete with someone unless you're in that whole 500-hour material participation camp. But really, it's about the material participation, usually what I would call step 2 on either real estate professional status as a strategy or the short-term rental strategy. So I've got a lot more things I want to say. I don't want to belabor it, but any comments on that, Nathan, what I've said?
Yeah, I mean, he clearly would have blown the 500-hour test, right? That's what's so crazy about it, is that he could have blown that away. So like, even if he's super excessive and aggressive in the time that he's claiming that he worked on it, 2,500 hours is a lot. That's a ton. There's a part of me that feels like some of it would have gotten erased. Even if you like cut it in half, cut it in 3/4, right? He's still hitting 7. Like if he only gets 3/4 of that time, that's 750 hours, right? That's still above 500. And so he probably would have qualified. And plus, like you're talking about, now we toss in some management time. Maybe he has his spouse or partner work on the property with him and they handle the management. We get to combine that time because people who file a joint tax return get to combine time from that perspective, right? So now maybe we're looking at 1,000 hours between his construction and her actual like management of the property at the end of the day. And who knows? There's multiple avenues that can be explored on this and take advantage. Honestly, Fortis could potentially even reach out to us if he's interested. Like there could still be some implementations that we could apply in 2024 based on what I've seen from 2020 that we could potentially do, right? Like just because he failed in 2020 actually doesn't mean that there's not tax savings that can be achieved in the current year.
Yep. And the other thing I just was thinking about too, I was trying to say this earlier. Basically, it's not only the say 5,000 that it was getting unwound, right? Maybe he got a $5,000 refund. Hey, now we've got to pay this back. But now let's add on top of that. Okay. Because that was 4 years ago, 3 tax years ago, we're talking about penalties of some sort, interest for all 3 of those years that he should have paid the IRS that money. And then on top of that, he's probably got some sort of representation from a CPA, would be my guess. I don't know if you know that, Nathan. Is there anything that indicates
No, nothing like, yeah, I can't really see that part. That part I'm unsure of. I'm
Okay.
unsure of like whether or not he had counsel or anything like that.
But let's assume he did, right? Maybe he didn't because it seemed like it was maybe just incorrect kind of representation or something like that. We don't know. But point is like we've got all these additional fees. And at the end of the day, it's just like we could have helped him either completely get away from this or correctly implement this with some strategies and things that we've seen. I mean, because we've helped, and just so people are aware too, as we're talking about this, we have helped several people, not only specific clients, but also people have reached out to us from other, tax strategy influencers out there that I'm not going to name names, but now they've come to us and they're like, I don't trust these people. I'm getting audited. I didn't get a whole lot of help. And we're having to now say, hey, we don't think you did these things exactly correct, or you weren't given the best advice. Here's really what you should have done, or here's a little bit more detail of what you should have known before moving forward with this strategy, instead of, hey, go watch this YouTube video or go watch this whatever, right? So we're seeing a lot of people come to us because they understand that we actually go through the details here. We understand court cases. We see what the IRS is looking at. That's the biggest risk. If you're a real estate investor and you're like, what's my biggest risk? It's when you're audited, okay? Like when you get audited, that's the only real time that like this is going to get unwound, right? Like we as like tax preparers and tax strategists, we, before you even submit things, we want to work with you to say, hey, let's a little bit pressure test this with the documentation to say, does this even make sense? Well, before you even filing your tax return, you should be working with us, right? Or someone who is a tax strategist to even figure out, is this the right path for me? So a couple little things I just wanted to throw in there for people listening. I'm trying to make this a little bit action-packed of like how we should be really moving forward, but just really trying to emphasize because I don't like seeing these cases because I know that they can be prevented. And we have helped hundreds, thousands of clients not get into this stuff. Or the ones who have gone through audits, we've been really successful in making sure that they're not getting all of these things undone successfully.
Hey Tax Smart investors, Thomas Castelli here, and I want to let you know that I recently started my own YouTube channel where I'll be releasing weekly videos on tax and wealth tips for real estate investors and business owners, and of course I'll be covering many personal tax strategies as well. But that's not all. I'm also going to be sharing the tips and lessons I learned by investing as a limited partner in real estate syndicates and funds, which you'll only find available on YouTube, and I'll be diving even deeper in Tax Smart insiders. And lastly, in the not so distant future, I plan to cover estate planning strategies for real estate investors, and you'll only find that on YouTube. Subscribe today so you don't miss a beat by visiting youtube.com/@ThomasCastelli or by searching @ThomasCastelli on YouTube. Again, subscribe today at youtube.com/@ThomasCastelli. I'll see you over there, but for now, right back to today's episode.
Anything else you want to add on top of the case, right? We talked about, the W-2 part. We talked about the management part. We've talked about the 2,500 hours, right? Those are kind of some obvious things. Anything else you would add on top of that?
I think we covered like a really good chunk of it. To just recap, if you have a W-2, you can't go for real estate professional status. And there's like always a caveat, right? Now, if there's some kind of part-time, if there's a cap on your hours, right? Maybe you don't work a full 40 hours a year. It's a possibility for you. It's not a no. It just means you're going to have a bulletproof time log and bulletproof evidence to show this. And so if that's something like, I would say maybe that's slightly aggressive. It doesn't mean it's wrong, just means it's aggressive. And that means that you need to work with someone who understands this like the back of their hand if you want to go aggressive with that. And because if you have someone that's sloppy, someone that doesn't fully understand it or totally get it, right? Like we see people who claim to know like, oh yeah, we work with real estate investors all the time, right? And then we see common mistakes constantly made, right? Electing and a bonus depreciation, not including -9 elections, things of that nature, right? These aren't like, those apply to reps, not short-term rentals, but same kind of caveat is that if you want to be aggressive, you need to work with experts. If you don't work with experts, then unfortunately, you're going to wind up paying their fees and then paying fees to the government as well at the end of the day. And it's not going to be a fun conversation you're going to wind up having there. So I guess that's what I would kind of say there. And then it's like, it's interesting to see the short-term rental strategy mentioned, or not even mentioned, right? Like that's what's so interesting, is that like no mention of 100 plus hours, no mention of 500 hours in this. It's what's so interesting. And that's why it's like clearly like not the best advice in this case. So I don't know. It's just something that's like really intriguing to me. It's why this case really stuck out when I was reading it, because the first thing it talks about is a short-term rental. I go, whoa, short-term rental case. We get to dive in, hear what the tax court's going to say now. And then I saw the real estate professional argument. And I said, "Oh man, it's over already, right?" So like I'm only on page 2, and I know the result. I know what's going to happen in page 5. So it's unfortunate. There could have been a case made potentially, but again, we don't have all the details. So like obviously, like this is working off assumptions here. It's like short-term rentals can mean lots of things, lots of people. So that's something to consider there. So yeah, I think that's pretty much all I have in like regards to the case. Is just like other things too, is that like the court always will walk through, right? Like 469 is possibly one of the most complex code sections out there. It definitely is. But before they even got there, they actually discussed, hey, you got to have ordinary necessary business expenses, and you got to have accurate logs of these expenses before you can even get there, right? You need to have detailed. Obviously, it didn't even matter because it was a passive loss, so they didn't really dive too much into that. But they still brought it up and saying, hey, Section 162, which is ordinary necessary business deductions, you got to have good records in this case too, right? They didn't even get to his records because like basically like, hey, yeah, it's passive loss, whatever, move along. You can talk with the IRS. What's substantial, like what's ordinary necessary here. But that's kind of like another thing to consider, is that like, hey, you got to have good books and records. If you can't substantiate or verify where your expenses are coming from, what they are, right? If you don't have a bookkeeper, an accountant taking care of that, and you're just honest, like no offense to all those out there, just using an Excel spreadsheet, you could be asking for some trouble at the end of the day.
Yep. Even with some software, we have found that there can be some issues if we don't have or pay for the premium, service of a balance sheet or a general ledger or a trial balance and so forth. There can be issues there. So let me ask you this then. We walked through that case. I feel like the main, points are full-time W-2, huge red flag, using a management company that didn't help, things like that. Trying to claim reps when maybe it should have been the short-term rental strategy being represented as like, this is what I was using. Several things going on there and whatnot. But let's now say they're in their shoes, still these two taxpayers, right? Married couple, I think we're saying here. What should they do? Or other listeners who are like, well, I'm two physicians, or I'm an airline pilot. We have a lot of people coming to us right now who are airline pilots, and their wife or spouse is either working or not working. What could full-time people like Freitas, right? What could they really do? What would be something that like they're starting from scratch, or they've got 0 properties? What really should they be talking about? We've been talking about it a little bit, but just to really drive the nail here, what should people be using?
Hammer home. If you want to invest in real estate, and you want to also be able to take the losses that come from real estate, reps is not for you. What you can do, however, is go after the short-term rental strategy and use that to basically purchase a short-term rental. Probably going to want to look at purchasing one that's in a short-term friendly area, or something that like you think is going to do well, right? We don't want, like, as Ryan said many times on the podcast, we don't want the tax tail to wag the economic dog, right? It's like, we want to make sure this makes sense as an investment. Let's see if we make sense first, right? Everyone's got different thresholds of what that matters to them, where they care appreciation, cash flow, et cetera. You can make that decision there. But if you want to be able to take advantage of it, then you're going to have to do the short-term rental strategy. What that means is your property is going to have basically Airbnb, VRBO, whatever platform, an average stay of 7 days or less. I actually found that out the other day, that New York technically does have short-term rentals despite it being outlawed. It's because people just like post it on Craigslist. So Craigslist even, I guess, if you want to do that and you want to subvert the government, don't necessarily recommend doing that. But everyone has their own threshold for risk once again. So is that you can do that. Got to prove 7 days or less for the entire year. Got to have 2 stays, right? Actually, something that I've heard recently on other podcasts is saying, oh yeah, as long as you get the short-term rental placed in service by the end of the year, you're good to go. Actually, we have another court case, Rogerson, 2022 tax court case, I believe. I don't remember the exact site at the moment. But what it basically states is if you have no stays, it's not a real estate case, but it applies in the exact same manner in this case to a short-term rental. If you have no stays, you have no average days of stay. So that means you're going to wind up having 0, because 0 stays divided by 0 is 0, right? Versus having 2 days divided by 3, whatever the average gets you to the math. You have no average at that point in time. So you have to have at minimum 2 stays before the end of the year, right? And like this is October, right? We have people who can purchase a short-term rental in the next couple of months and execute this strategy potentially. So you do that, then you have to materially participate in it, which we talk a lot about this. You probably need to hit 100 hours and you got to spend more time than anyone else, or 500 hours, right? 500 hours at this point in the year, it's going to be a bit of a stretch. You can maybe make it happen if you want to, but that's an opportunity. There's also the 100 hours plus more than anyone else test that you can do as well. Basically, you got to spend more time than any cleaners, any contractors, anything of that nature. You have to materially participate. You're going to have to spend some time, right? Like I get that doctors, physicians, attorneys, you guys are busy. You're going to have to put in the work to get this to qualify and be able to use these losses, get them from being passive to being active to offset your W-2, your business income, right? That's the only way you're going to be able to achieve this if you have full-time jobs, right? If you have a spouse, that doesn't necessarily work. Maybe they stay at home with the kiddos. Maybe they have a part-time job, potential there, right? I've talked to many investors who like a spouse is interested in doing this and they can achieve reps at that point in time. If so, great. They can go after that. But if you got two working spouses, you're going to have to go after the short-term rental strategy. And it's going to be a little bit of a grind year one, but it might be worth it for you at the end of the day if you're looking to save on tax and get the appreciation that real estate provides.
Yep. So one thing just really fast that I would love to do, I'm not sure, how much we've done this in the past. I would like to just share my screen real quick. So one thing that we haven't talked about a whole lot is essentially, tax savings. What does this really look like with a very simple example? And what I'm just going to show people here. And again, if you're just listening to the podcast, go to our YouTube channel. You can watch me do this a little bit just with the Excel spreadsheet, just a blank one. Okay. And again, caveats is this is a lot of assumptions. I'll walk you through just really fast. But what I'm trying to show right here is what if you're, say, in high income individual, you're in the 37% bracket. Again, we have a lot of people who come to us who are physicians, doctors, high tech executives. They're people who are in sales, people who are pilots, a lot of these very high income, high net worth individuals. And they're just like, help me understand how much I could get in tax savings. Here you go. Okay. So my example with meeting the short-term rental strategy is really the assumption. Okay. That's what we've been talking about. That's why we're pointing this out, W-2 people. Okay. Let's assume you've got a purchase price of $750,000. You can do the math with various different examples. You see how I'm doing this. What we first have to do is then split out just the building portion. Okay. We got to make this building land split. Land, maybe for a short-term rental in a more desirable location, I'm going to assume is about 70% of the cost. Okay. So it gets us to 525 here. Now, okay, we've got our building portion. Now what we do is we get this cost segregation study done. Okay. Cost segregation study is going to help us break out the 5, 15, and 39-year property. I'm going to assume, just again, some numbers here, 25% of the building cost is going to be our bonus eligible property. Okay. That gets us to the 131,250 right here. Now we're in 2024. Okay. We're currently looking at accelerating 60% bonus depreciation from our bonus eligible property, 5 and 15-year property. Okay. So 60% is 78,750 of the bonus property, which was 131,250. Okay. Now, if we're only looking at tax savings from really doing this acceleration, right, we're not even taking into effect any other sort of net operating income or loss. Just what's the benefit of us using a cost segregation study, adding more losses, non-passive losses to offset that W-2 income? At a 37% bracket, we're looking at about $29,000 in tax savings. Okay. So for all of you out there who ever come to us and you're like, help me understand how much, I'm just going to point you to this podcast. Okay. In whatever minute we're at here, I'm just going to help you see this. So this is a really short example, right? You can do the backwards math. Those of you who are, listening along, maybe you're writing this down, maybe you're watching this on YouTube, you can come in here, do your other numbers here and see kind of how I'm getting to this. Again, lots of assumptions, a lot of things that, again, I'm assuming, right? But please just know that this is something that Nathan and I do all the time with our clients. This isn't new to us. We're currently working with hundreds of clients, like even just Nathan and I, over the years. And so lots of ways that we can do this. W-2 people, please consider the short-term rental strategy. You have time. We've got a quarter left of the year. I want to pause there. I don't want to belabor the point of that. But any other comments you have, Nathan, either one, about the case, things that people should do, pitfalls, again, that we want to highlight, anything like that we want to talk about before we kind of wrap up?
You nailed it right on the head, man, with that. I guess like the only thing is like I'm not sure, like I think you said 30% should probably get allocated to land, right? Versus building, have 70% be allocated to building, just FYI. Like if you just like maybe like I might like maybe I heard that backwards and maybe somebody else heard that backwards too. But yeah, 70% building, 30% land type of situation potentially. Now it could be a higher value type area, it could be in a city, it could be, wherever, that's a very key indication that people don't really consider all that often. Can't depreciate land, unfortunately. So can't take advantage there. So no, there's like, it's fantastic. Which like what you highlighted there. I think that's definitely something. And I guess another thing to highlight too is that as people are like have been using more of these strategies, and also the IRS has gotten additional funding. And so they've been an underfunded organization for a long period of time. And now they have had they hired 80,000 employees, not agents, as some people politically have come out and said. It's not 80,000 agents, but a good chunk of those are agents. And so they have more people who are out there. So there are more audits that we have seen personally that have popped up in the past couple months, just asking maybe basic questions about these strategies. And we have been able to help a lot of people out with this, and even people who not necessarily worked with us from the start, but have come over, right? Who have worked with some significantly large influencers out there who say, oh yeah, this is no problem. You can do this 10 times out of 10, right? And so turns out you can if you do it right. If you do it wrong, you screw it up, you might have some troubles. So just an FYI there. We are like, I don't want to like toot our own horn. We're a very technical firm. We don't do things unless we can substantiate it with the tax code. If we can say, hey, point to where we get the citation. We can point to what our thoughts are on this, or the tax court case, or what district court, Supreme Court, whatever it is, we substantiate what we do from a law perspective. Some things are gray area, sure. We will make sure that we can substantiate the things that we do before we start proposing the strategies.
Yep. Awesome. And just to kind of wrap up, if you're interested in more of these, we have had other episodes. I can't remember the specific numbers where we've gone through other court cases.
Very early. Yeah. It's like a very early stage. So if you want to go listen to those, just scroll up right to the very beginning of the podcast. You'll see a series of like short-term rental series. You can pop on and start listening there.
Yep. And I think you and Brandon are doing a lot of things on LinkedIn, kind of coming out with these, evaluations and summaries of kind of your take or things that you're learning from these court cases. So follow, Nathan, Brandon, whoever I'm on LinkedIn too. If you're interested in more of these court cases and like these deep dives of kind of real specifics and like what went wrong during these audits, please feel free to follow these guys. Otherwise, we'll kind of sprinkle some of these in, especially as they come out. It's not like we get one every day. It's like maybe a couple every year are kind of more geared toward 469 or real estate something. So they come out every once in a while. But because it's fairly new, we wanted to take the time to just kind of walk people through it, things to be careful of, ways to prevent that, other strategies to evaluate, like the short-term rental strategy, ways they could have done things differently. And hopefully, we've kind of fulfilled our promise of what we've kind of wanted to explain to people here. But if you're interested in more of this, again, we've got our blog as well that Nathan and Brandon are writing a lot on. But Nathan, thank you for jumping in here. Thanks for taking so much time to review that for us. And hopefully our listeners have gotten a lot of value out of this. But we will talk to everyone next time.